Hello, and thank you for joining us for this World Council of Credit Unions virtual event, Driving Action and Disclosure on ESG Risks and Opportunities. My name is Greg Newman, Director of Communications for World Council. Credit unions are not immune from the dynamic environmental, social, and governance risks and opportunities that all organizations are grappling with. Issues such as climate stress testing, diversity, equity, and inclusion challenges are more required than ever for an updated governance framework and coherent communication to stakeholders, including members, employees, business partners, communities, and regulators. Today, Christopher Geiger, Director of Internal Audit for Lockheed Martin and a Board Director for Mid-Florida Credit Union here in the U.S., will introduce the double materiality concept as a way to analyze these issues and integrate them into your organizational governance. In addition, sustainability assurance methods will be outlined to complement the growing importance of non-financial data in decision-making and disclosure. And if any questions come to your mind today as you listen to Christopher's presentation, please feel free to use the Q&A button that's on the bottom of your screen to type your questions in there, and we'll be asking him some questions as time allows. We want to let you know we are also offering Spanish interpretation today. Tómese un momento para hacer clic en interpretación y elija su idioma, inglés o español. And this presentation is being recorded and will also be available later today on the World Council YouTube channel. Christopher, thank you so much for being here. I'll hand the floor over to you.
Thank you very much, Greg. Everybody see me okay? Excellent. Well, I'll go ahead and get to the presentation here. I would like to say that this is kind of bringing two of my passions together. So I've been leading enterprise risk management and sustainability at a US Fortune 100 company for a few years, as well as being on the board of directors of a credit union here in the United States. And sometimes those may sound like different things, but in fact, there's a lot of similarities. So I got a question here. Hopefully it's not a trick question, is how do you eat alphabet soup? We were all in highly regulated industries, but as I say there at the bottom, an acronym at a time. We do love our acronyms. And there was even an acronym in the title of this presentation, ESG. And it's okay if you didn't know what that meant right off the bat. There are too many to know at all times. It's environmental, social, and governance. And you may wonder what's the difference between that and sustainability. So the way I look at it is ESG is when it's in a financial or investing context. So you're going to hear about ESG a lot, and it covers essentially almost anything that can be in sustainability, but it's when it's in that financial world, which of course is where we all live in credit unions. But sustainability is something that affects all organizations, not just companies, but any kind of organization, governments, individuals. And that is, how do you live sustainably? How do you live in a way that is circular, where you're giving back as much as you're getting? So if you think about sustainability as a philosophy, as something that anyone can do, ESG is what financial organizations can do, or when an organization is talking to their credit union or to their banker or to their insurance company, it's often in the language of ESG. So you can kind of keep those separate in your mind. And I'm not going to explain all of the rest of the acronyms on this slide, but suffice it to say that there's an awful lot. So the SEC, the Securities and Exchange Commission, has proposed a rule earlier this year, and they're planning to get that out by the end of the year. Of course, there's likely to be litigation, and of course, it doesn't affect credit unions, but all listed companies in the US will be affected. And you'll see in some of the future slides how that's actually going to trickle down and affect all kinds of companies and organizations in the US as well. The EU and the rest of the world are completely on the same page with these regulations around sustainability, and especially the environmental or climate related risk part of this. So you see there's actually two areas in the EU, and those on the line from the EU probably know about this very well. But for those others, there's two aspects. There's the sustainable finance disclosure regulations, and that's really for any financial organizations, including credit unions. And then there's another corporate sustainability reporting directive that's for companies, and that's really actually happened later. It's a little interesting, but they need to feed the data for the finance organizations to be able to report on their sustainable finance disclosure regulations. There's a two-punch method there to make sure they cover everyone. And then for all the accountants out there, of course, IFRS, the International Financial Reporting Standards, has started a Sustainability Standards Board, the ISSB. And that's really going to come out and help streamline reporting. And you'll see in a slide in a bit, the alphabet soup of different ESG reporting and disclosure areas that currently exist. And this is trying to really put a framework around likely most of that in a similar way to IFRS and accounting, financial accounting. And the list really goes on. And so you see, I say, how do they affect credit unions? Because you could look through all of these and say, well, if I'm a US credit union or I'm a credit union, I saw one of the folks who dialed in is from Nepal and many other countries, how would this affect me? The fact is, if you're interacting with companies that are under these, you're going to get questions. Or if you have vendors or you have any sort of relationships or consultants, it is going to reach your organization. So you're not immune. Okay, so moving on to the next one, I'll really go into some risks and opportunities that will be directly affecting your organization. Member engagement. You see a quote over there from Deloitte. Younger members are increasingly making choices based on sustainability. And this isn't just what they buy at the grocery store. This is their financial decisions, their mortgages they make, what cars to buy and how to buy them. You see both Gen Z and millennials. Those are basically anybody under 40-ish at this point. They put the number 2 concern after cost of living as climate change. This is an incredibly important issue to them. And if you are marketing to them on some of those other issues that aren't as important as those top 2, this may trump that if someone else is scratching that itch they have about climate change. Another way that many jurisdictions are coming to make sure that all organizations take into account climate change is insurance. And if it hasn't affected you, you may be thinking, well, wait a minute, I've heard of bank stress tests for climate change, but what about insurance? There are ESG risk factors to underwriting and reinsuring. And so if you can imagine, if you're a reinsurer, you're concerned if there's increased climate-related disasters happening. So this is starting to flow through to areas that are going to have more increased wildfires, climate-related issues. It doesn't have to just be rising sea levels, but of course that's one aspect. And I put a few headlines on the right to talk about just some areas that you may start seeing in underwriting for your own organization, but also for the organizations that are your clients, and they may be coming to you to discuss this or to understand how it affects their relationship with you. And then thirdly, and I will describe this, don't worry, scope 3 greenhouse gas emissions. And credit union operations are likely part of scope 3 emissions. So here you go. We really have 3 scopes of emissions, and I'm going to spend just a few minutes to go over this because although many of you may know this, it's important to understand in the whole context of sustainability. If you hear about, COP26 that recently happened, and the Paris Accords, and countries, all kinds of jurisdictions and companies working to reduce greenhouse gas emissions, you always have to look at the fine print and say, is it scope 1, 2, or 3, or all of them? And scope 1 emissions are greenhouse gas emissions that you directly emit. So as the picture shows, if you have a factory and it's emitting greenhouse gas emissions, and that's beyond CO2, there's others like methane, those you would count as your scope 1. Scope 2 is from purchased utility services like electricity. So if you're buying electricity, and of course through the grid where you are, that comes from a coal power plant, then those are your scope 2 emissions. You've paid for that person to burn that coal for you. And so you need to put that on your books. A lot of people, scope 1 and 2, they kind of understand, it makes sense. And some goals are only around scope 1 and 2 that you'll see. So when you see someone going to carbon net zero or various other terms, it may often be just scope 1 and 2. For almost all organizations, scope 3 is larger and dwarfs scope 1 and 2, unless you're in a pretty small, unless you're a utility company. And scope 3 is all the rest of your value chain, and that is both upstream and downstream. So upstream would be your suppliers, your purchased goods and services, your business travels. Whenever one of your employees flies, that would be part of your scope 3. It can get to be a lot if you start to see where your components come from, going all the way back to maybe how they were mined, if it's a material or something like that. And downstream is the use of your products. So if you sell a widget and then somebody uses it for 10 years in their home, all of the greenhouse gas emissions involved in using that, for instance, the electricity, if it's an electrical device, would be your scope 3 emissions. The distribution, so if you're shipping your product somewhere, the disposal of it at the end of its life, however that happens, hopefully recycling or some other disposal, that is all scope 3 emissions. And you may be saying, well, I'm a credit union. I don't make widgets, so I'm okay. But look at the quote over there from PwC. Larry, lending, underwriting, investment activities are 700 times higher on average than a financial institution's direct emissions. And that makes sense, right? If you look at what you do, there's what's called financed emissions. And so your scope 3 emissions include, in some cases, anything that you're giving a loan to. And that could be a consumer, it could be an organization. And of course, if you're not real familiar with scope 3, you may say, wait a minute, raise your hand, I'm double counting. How does this make sense? My scope 3s are someone else's scope 1 and 2s. That's completely true. There's a lot of double counting going on if you were to add it all up. So you can't go to everyone's sustainability report and add them all up and think you have something that is the world's emissions. There's a lot of double counting, but what they want to make sure is that you don't just look at your scope 1 and 2. And by they, I mean regulators and activists. They want to make sure that you are considering the whole value chain. Otherwise, if you imagine if only public companies are regulated, then they may push those emissions to other places, to non-public companies or to other consumers or others. So we want to make sure that companies are aware. So if you are going to add up emissions from all the different companies and organizations, you need to just look at scope 1 or scope 1 and 2. But if you're thinking of yourself, it's often scope 3. And now you see how a credit union could be part of someone else's scope 3. And so you are going to be affected as others are regulated. Maybe you use a consultant to make your to use for your IT. You use a cloud for your back office IT organization. Well, you are then part of the scope 3 of that large multinational company. And as they start to remove emissions or they have new targets and goals, that may directly affect you. So the topic I mentioned actually right up front, Greg brought it up, was double materiality. And this is a way that I found you can start to think about all sustainability issues, not just climate change, but also social aspects, to be able to talk to your board and your executives in a way that that is in the right language, because we all understand financial materiality. That's a very understood concept that really really gets right to the heart of the matter when it comes to businesses and making decisions, especially risk management. What is financially material or not? Double materiality is actually a concept developed in the EU. It's actually written into their regulations. The picture I have here is from actually the non-financial reporting directive of the EU. So I thought it was a pretty good illustration there. And it's the concept that your organization may have environmental and social impact that is materially relevant to stakeholders beyond or in addition to traditional financial materiality. And there can be many reasons for that. One is that you have a time horizon, financial materiality. And some issues we found, like climate change, may go well beyond that. So if you're doing something now that is essentially costless to you, but it's going to affect the world in 50 years, that's not really financially material to you, right? You're going to have an entirely different executive suite. You're going to have maybe different stakeholders and goals. Most companies do not look out 50 years. But if what you're doing has a cost that doesn't hit until 50 years, you have a mismatch, and it's not making its way into your financial materiality. So what the EU and now many others have said is you need to look beyond just your financial materiality and think about double materiality. And you see in the second bullet, it's anytime the use of a commons, and by commons, I mean things that we all share but don't have a cost for. And you can think of examples. There's two here: the atmosphere or oceans. So in the middle of the ocean, right? No nation state owns that. and consequently, there can be issues. And if you think about the plastics in the ocean or other commons you can think of, I'm an engineer by background. I think of electromagnetic radiation, where if we didn't all agree to rules, cell phones wouldn't work, right? Because you'd have conflicting use of electromagnetic commons that we all have to decide between nation states how we're going to operate. The same works with the atmosphere. The same works for oceans, and you could even talk about space. Low Earth orbit and beyond as a place where there's not one nation that controls it. So we all have to come together and understand it's not costless. We have to understand the double materiality of it. So I will move into that space sustainability example. Again, the company I work at has a lot of space operations. As a risk manager, I often think about this domain, and I don't use it because I think your credit union is going to open up a branch in low Earth orbit, although I encourage it if you do. But as an analogy, so you can kind of think divorced from climate change or your daily operations, how would double materiality work? And I'll use a real example that you probably wouldn't think of, space sustainability. And there are multiple issues around it. Access to space, right? If it's cluttered with junk, you may have trouble with access. Debris, that's, when we launch things into space, we often leave them there. It may take, dozens or even hundreds of years for things to naturally come back to Earth. And that can be really an issue, especially with debris hits. Two large pieces hitting makes thousands of pieces in low Earth orbit that are now a big issue. And of course, what affects us is the benefits to life on Earth from space-based systems. And again, you may think, well, my credit union doesn't benefit from space. What are you talking about? Well, if you use GPS for your cars to get around, you're definitely benefiting from space. If you use communications, especially if they go across continents, you're very likely using space communications. You're using the weather data that all comes from space. So there's a lot of benefits actually to low Earth orbit being, reasonably accessible and not having too much debris to everyone's life here on Earth. And then I do mention the electromagnetic spectrum. So, there's no, like in the US, right, we have a regulator that says how you use different spectrums so that radios or Wi-Fi or the other things work. And of course, the same regulation happens between Earth and space, but between space, there's no national regulator, satellite to satellite. So you see on the comment on the right, when we think of double materiality, and I'll take a space example, when you're launching to space, it's not material to you, to your company likely, how your objects come down. They're likely not to affect, your future launch, very unlikely. But if you think of the wider commons that is space and what's material to that environment, you can go, wait a minute, I need to step back and be more sustainable because if we all have to take responsibility individually, or no one's going to take collective responsibility. So I'll give an example where actually my company and others have looked on areas where you are not regulated under one nation or maybe some treaty. So companies or organizations, in your cases, credit unions, could come together and decide we need to make something on our own. Something that could be imposed upon us. We need to do the right thing and be good corporate citizens. So an example is a space sustainability rating. And that is where satellites or other objects that are going to remain in low Earth orbit or otherwise take on certain requirements that say, hey, I want to deorbit when I'm done, or when my battery stops working, it's not going to explode, or other areas like that, and actually rate themselves. And how the market can help with that is then if you're a user of space assets, then you may say, I'd rather use a sustainable space asset than not. So even though it may cost a little more money or maybe more regulation or to do testing to have that rating, the SSR rating, the space sustainability, there's a benefit in the end. It's actually a World Economic Forum initiative, and I just use it as an example where there's no overarching nation or regulator saying you have to do this, but distinct organizations can come together and say we should do this together. So having used the space example, which I know you probably don't have a direct relationship with, but I think you can understand, I really talk about a double materiality framework. And so you see on the right, there's that traditional materiality. So if there's any accountants in the room, right, this is extremely understandable, right? Your organizational strategy and operations, how do they affect and are affected by financial performance? That's clear. That's what we all have to talk to our regulator and our stakeholders about. But what is that wider world for you? And corporate organizations actually do assessments to figure that out. Because if you may think the atmosphere is obvious, and it is in an ESG sense, but there are others, and they're not the same for everyone. Your company may not affect the oceans or vice versa. And I put at the bottom, right, a catch-all of other non-financial material issues. I don't have a long list that I can tell you is exhaustive, because you may invent a company, your credit union may find an issue where there's a commons you're using, there's no cost to you using it, but in fact, you need to use it wisely because in the long term or for other reasons, it is not inexhaustible. There is that comment, and you see in the bottom bullet, the tragedy of the commons. And that is that, we humans, when something's costless, we tend to overuse it. And so we have to kind of rein ourselves back in. And the atmosphere is that key issue that we're all trying to tackle right now under double materiality. So the way to do this in practice, coming from a corporation, is through governance. Wanting to do something, wishful thinking and hope, right, is not a plan. So if you want something done in an organization, in a credit union, you need to put governance in impact. So you have financial governance, you have likely an enterprise risk management regime where you understand maybe for your regulator or others what to do. But what about sustainability governance? Because otherwise, when you change leaders or when you change, mission statements, is that going to drastically change what should be a very long-term solution to human problems? So there's a lot of words, comments that come around this. There's sustainability materiality assessments, which I don't want to get hung up on the word materiality, because again, it's not the same thing as financial material. There's, I've used core issues assessments that gets the word material out, and you can sometimes get beyond that financial discussion, or you can call it a double materiality assessment. But whatever you call it, it should drive operational action and additional corporate governance. So if you look at your corporate governance as it is, you could say, how do I augment this to ensure that we're covering double material issues in my organization, not just the financial ones? And you see the bullets on the bottom left, you could align those with financial regulatory governance. It doesn't have to be distinct. And I'm not saying you have to open up a new function or a department. Sometimes an ERM group, an enterprise risk management group, can add sustainability risks, or your in my corporate world, a corporate secretaries type organization, or even SOX, the Sarbanes-Oxley governance for publicly listed companies, which has very understood governance, can add this as an additional item. It's not something distinct you set up, a rival parallel governance. And make sure it's risk informed. You can look up any of the acronyms around ESG and find hundreds or thousands of ESG issues. No one has goals around all of them because they aren't all important to you, to your organization. So as a credit union, you have to be risk informed. You have limited resources, and say, what are the handful, maybe a dozen or less issues that are actually important, that if you took action, your members would care, that it could affect them. And then it's going to also benefit those opportunities I mentioned, not just the risks. And with appropriate assurance. So you saw in the intro that my current role is as internal audit. So I actually moved from leading sustainability to leading internal audit at a Fortune 100 company. And that may seem like an odd transition, but the fact is that once you have governance in place, and once you have goals, and you're treating this like a serious governance issue, you step back and say, wait a minute, we have to assure this. It's not exactly auditing, right? Assurance is kind of a bigger umbrella as a term than auditing. But you have to, how am I making sure that when I talk to my regulator and my members and other stakeholders, a company, right, investors, that I am telling them the right information? that we're making sure the processes exist in the company such that the information is true and the goals we set, we're going to make progress towards. So the example I can give, and I'm trying to give examples after I give a concept, is sustainability integration with ERM, enterprise risk management. Again, at a company I led both together, and you often don't hear about that. You probably think of sustainability as a distinct organization. Of course, sustainability touches a lot of different aspects of a company or a credit union, and ERM is often very board focused, very financial focused. But I found that there was a lot of connection. And actually in one group, we were able to cover both, and it really helped inform enterprise risk management. So when you have a risk universe and you work through maybe a very large universe of risks that your credit union is dealing with, and you go down to the small number that you're going to probably do some internal audit on, you're going to take action, maybe assign points of contacts that are there to reduce your risk down to a risk appetite. Are you taking sustainability issues seriously? And when you have those organizations working together, then you can. The risk reporting tied to sustainability issues. When you're talking about something with your organization, remember I mentioned Gen Z and millennials, right? Those folks that may make up probably over half of your staff, if you're like most modern organizations anywhere in the world, that's going to help motivate them. To mitigate risks, and they may be financial risks for you. So if you were just talking about them in a financial sense, this is going to help, our membership or our net worth because we're going to do this. That's one type of motivation. But if you say, oh, in addition, this also helps us progress this sustainability issue, you're going to likely catch their passions and motivation even more than if you just focus on financial issues. I have to extend just a moment. I have to extend my VPN. It popped up in the middle of the presentation. Let me just do that very quickly. Sorry. Cybersecurity waits for no one. There you go. So to move on to the time horizon of that interaction between ERM and sustainability. This is a chart I developed to show that the crossover when risks can go between the two. So sustainability, and you see the timeline going out to the right, really extends far beyond where your corporate or credit union strategy or ERM is looking. And you may have a 3 or 5 year or maybe even 10-year time horizon that you do scenarios and you worry about risks and hopefully take action on them. Sustainability is much further, right? If you're looking in the social world, maybe you're looking at generational time spans, in the 20 to 40 to 60 years, and how you're going to make sure that your membership and your employees are taken care of in that way. In the environmental world, again, climate change, you often talking about well beyond decades to see a result. So sustainability really has that far-sighted look. But as time comes in, it likely, the governance or the risks and opportunities often merge more closely into your operational plans. And so you see, I've drawn here that there's a crossover point over which your normal corporate governance, your standard, I should call it, traditional corporate governance, kind of takes charge or takes over. And it was interesting in the organization that I was leading that had both, that you had to have that transition period where they work together. And then there's always some aspect of one or the other, but kind of one of them takes the lead or the other. And that's emerging risks. And which is often a troubling area, right? So if you ever have a brainstorming session or you go and look at external resources and you say, okay, what are our emerging risks right now? You could talk to a futurist, right? Check the crystal ball. That's one way to do it. It's not always the most effective, but one way you can do it is look at sustainability, and that actually is maybe a more reliable crystal ball, because it by nature is looking further out and you can see actions coming at you further off. So how does that affect your organizational decision making? Well, it's not just about risk management or, we'll talk about disclosure in a minute. Again, disclosures not helpful at all without action, without decision making. So the double materiality should be implemented such that you're making decisions based on it, that you're actually taking that into consideration. So it's implemented before a crisis, for one thing. And that could be any kind of crisis, you know, cybersecurity, hiring wise, environmental. You want to have this governance in place before you need it, just like you do with financial or for your net worth, right? You don't go build your net worth when you're in trouble. You want that there for that rainy day. You don't want to develop governance on the rainy day. So if you don't think these things affect you, step back and go, well, maybe I should do it now before I think it affects me. If you acknowledge those risks, it can increase your resilience. And resilience can be a buzzword nowadays, but I mean kind of organizational resilience in times of stress. Doesn't have to be a crisis, but in any time when things are getting a little more difficult, resilience can help you bounce back, can help you maintain or even increase your performance. And when you're thinking of things in a double materiality way, you've likely put in place processes that help cushion you in those issues. And it really is the impetus for circularity. So by circularity, I mean, you know, a circular economy where we don't just, you know, take things, humans use them, and then they're waste. We really need to move to a place with the billions of humans that we have where products, and you see this in the marketing and in your own purchasing, can be circular. A little beyond recycling. And if you think in a credit union sense, how are you being circular? I think it will help drive actions that you thought weren't operational for you. So I'll go back to another example, and I promise we will get to questions here in a bit. So feel free to put those in the chat and save those up. But ESG-informed internal audit risk coverage. So again, that's my current new world as an internal auditor, and environmental, social, and governance issues can help drive through that double materiality concept what risks we cover. And so the graph here is showing, and you know, this is an example. It's for illustrative purposes. Various ESG risks. So you see under environment, there's energy and water and waste. Under social, of course, there's diversity and inclusion, but there's also data privacy and workplace safety and governance, all the board structures, your executive comp, your disclosures, ethical business practices, all kinds of areas. And some of them, and you see in the middle, I put a circle for financially material. There are some risks that your ERM group, your enterprise risk management, or your risk managers say these are financial material. With the board and executive management, you want to maybe mitigate or somehow treat those risks. But as I put here for illustrative purposes, there's a lot to those ESG issues beyond the financially material. And you may say, well, that's great. I'm not going to worry about those too much. You know, it'll all come out in the wash. But in fact, I'll show here in the next slide that it's a little more. So the SEC, the Securities and Exchange Commission of the US, is proposing some new rules that I would say are somewhat unique in the last 70 to 80 years, in that they're asking for disclosure from public companies beyond the financially material. And I know this is happening in many other jurisdictions around the world. So you see here, I drew some extra, some area where in some areas, and it's not just one, you're now large companies, not credit unions in most part, are going to have to report beyond the financially material. So you see in climate, in cyber areas. So I put data privacy, certainly in the disclosure governance. So both, it touches on E, S, and G. The SEC is going to be looking beyond the financially material. Now, there's two aspects of this that I think you know, you should take to heart. One is that where the SEC goes, our regulators may eventually follow. So you can see this as a harbinger, something you want to at least keep track of, but potentially prepare for. And secondly, I mentioned that there is scope 3 emissions in which you're not immune from being part of. So if a large company that is listed maybe in Europe or in the US or in any major index is taking goals around their scope 3 climate emissions, your own members are likely affected, or you yourself are. And so there are going to be second and third order effects, and that's kind of the intent of the regulation. And then to build it out, there we go. The next one, you know, the internal audit coverage is where I'm going here with the action. As you see, the white area on the screen is, again, just illustrative, you know, dummy data of, as internal auditors, how do we look at, of course, the center is financially material, but how deep do we go in these ESG areas beyond the financially material? And you see, you know, further in some areas than others, and you lay on that what the US SEC is doing, or think of your country and what are your regulators doing, and you could map this and then see and inform your internal audit on where you need to be focusing. And this is a very practical governance issue. You know, it's not often that governance is interesting or exciting, right? But I think we're there, that you could map this and say, oh, I see, you know, financially material, got it, but actually regulators or other organizations, maybe we signed up for a, you know, a voluntary thing, that's we're encouraging us to do something with ESG. And you can map that and go, oh, our internal audit needs to keep track of this, just as if it was financially material, and make sure there's coverage. There's another area of this about prioritization that I find interesting, is that, in fact, when you add corporate governance in these issues, they actually sometimes become easier to audit. Not to be you know, backwards here, but we all know that you know, in accounting, with all the rules, sometimes that's actually easier to audit than a wild risk that comes up that's lesser known. And maybe that was cybersecurity for you, you know, years ago, or maybe now it's around social issues. So sometimes internal audit can actually go, wait, we're going to just audit the governance that's now been created in these issues and move our audit time to something that's a little more unregulated. So it's kind of a backwards way of looking at it. But I think there is, for those internal auditors out there, there is some reason to be able to actually rely on governance once you've done it a few times, and understand that's where automation could happen. And you may move some of your more complex resources to other areas, again, more future looking, that haven't been regulated yet. So over to disclosure, I always like to talk about action before disclosure, because quite honestly, a lot of times you'll hear about just the disclosure, right? You'll go to a webinar and they're all talking about, you know, how you report on things. But the fact is, like I've said before, it's really irrelevant if you're not taking action. But it is important, and it's an area where our members and other stakeholders are looking for information. And I recommend making a roadmap of not just what you're doing now, and I give some examples here, again, just the template, but what you're going to do in the future. And if you plan ahead for it, then you can say, what do I have to do now to be able to report in the future? So the SEC guidance, the US Security and Exchange Commission changes that are likely to go in by the end of this year are happening pretty quickly. So by 2024, they're looking for listed companies to actually give a lot of data around climate related issues. So that means they have to be measuring it in 23, and then report on it in 24. That's a pretty tight time frame to affect corporate governance at, you know, the titans of industry. For yourself, you think, what if you had to do that? Now, hopefully, your regulator, you know, understands and maybe doesn't give you quite such a tight time frame. But you need to prepare. And you see in the bottom left, I think one helpful thing is to have a legend of who are those stakeholders, and understand that you're going to write and disclose differently based on who is it for. And this is for corporations, so I put customers, but really, you know, you could think of it as your members of your credit union. What information do they want to know around sustainability? And it may be different than what you see in the blue, you know, your investor, or this case again, company investors and government regulators, let's focus on that one, want to see. And you may not have one disclosure that covers all of it. That's why you'll see oftentimes there's more of an index or a matrix. And as you want to communicate the different constituencies around environmental, social, and governance items, you might want to have different methods to do it, because it's just too challenging to do it all in one document. I see I warned you about this chart, so you can't gasp too loud about the laundry list of organizations that create and flow and then use the data in ESG. And if you thought financial data and accounting or finance was challenging, really this is This is more so, I would say, currently. But non-financial data flows from organizations on the left through various frameworks, all of which essentially are voluntary at this point. And many organizations do multiple. So they may do GRI, and in the US, say SASB and others. And then there's the whole ecosystem of raters and rankers. And some of those you'll recognize because they do financial ratings, and others are new and bespoke in this area. And then there's aggregators that a company or a stakeholder on the right often pays for that service to aggregate the data and then understand it somehow. This is quite a jungle. And as a credit union, you have to look at this, or in my case, often as a corporation, and say, wait, I don't want to get lost in the weeds here. Instead, I'm going to pick my battles. I'm going to understand who I'm going to work with, and others, you just have to let it go, right? What's material to the people that you are trying to communicate with? In this case, maybe your members and regulators. Maybe your corporate credit union. You know, there's the different people who you want to make sure they get the right data about you. And so you can use, a map like this. And by the way, I drew this late last year, which means, of course, it's wrong and changed because this is changing on a month-to-month basis. But if you map this, kind of like a stakeholder map, and then you pick, again, this is more of a laundry list. Then you go and say, wait, which ones are we going to do? And do that deliberately. Use a double materiality lens on which things actually make sense for me. So you're probably going to ask what's next for disclosures. So I'll try to beat you to the punch there. But there's been a lot of consolidation and change, and it continues. So SASB and the International Integrated Reporting Council, or Integrated Reporting, they merged last year. The International Sustainability Standards Board that I mentioned as part of IFRS is coordinating more with what's called GRI, which is run by the Global Sustainability Standards Board. Sorry about all the acronyms, but this is the world of ESG. It's the world of acronyms. So there is some consolidation going on. That will take years, but it's slowly happening. The other thing, though, is I've mentioned the SEC a number of times at the bottom here, that between the SEC and IFRS and their changes and their, I'll make a coin a new word, accountingization of sustainability, I think you're going to see a little more standardization across this. But again, we're still a few years away from that. And if you think about your own credit union governance, what do you need to do to prepare for this becoming, similar or analogous to accounting? So I can't get off the stage without talking about assurance, which is my current role. And there is independent assurance out there. Now, notice I'm not saying audit. That's not really a term you want to use, right? It has specific meanings. And so it's often called verification, validation, assurance, various things. There are dozens of standards. It's not, more like where there used to be GAAP, generally accepted accounting principles, and there still is in dozens and dozens of countries. IFRS is, worked to align that. We're not there in the data assurance world of ESG or sustainability. I mentioned CDP here, the Climate Disclosure Project is what it used to be called. It's now known as CDP. They recognize over 30 different standards. So if you want to be accredited as having goals that control your greenhouse gas emissions, the CDP, which is a well-known organization, said, you could use over 30 different standards to do that as you get assurance. So there's different levels of assurance, limited, moderate, reasonable, I mentioned here. But it's better to have the right data assured than to not do assurance. If you just put out a report or disclosures, but have no assurance, I think about that with your finances. Like, you wouldn't do that. You wouldn't go out and put out your numbers and say, yeah, but we didn't have anybody check these. And the same is happening in the sustainability world. So whichever standard you want to use or assurance vendor, it's likely a good way to start, even if it's limited and you're starting out in this world. I will say, somewhat recently, your large accounting firms like the Big Four and others are ramping up in this area. So I didn't list them here, but I can assure you, probably whoever you use to do your financial accounting is moving in this direction as well. All right, so before we have about 10 minutes for questions, I'll just summarize quickly that sustainability ESG issues, risks, and opportunities are reaching much further than publicly listed companies. If you read about it in your local newspaper and it says, it's only for large banks, or it's only for these big public industrial companies, I really see it extending quickly well beyond that. And double materiality can be a guide for your actions. As you see all the hundreds or thousands of potential sustainability risks, don't be overwhelmed. Say, what are those few that are doubly material for me? And then, as the third bullet says, put in some governance. Like, you know how to do this. This isn't new. You don't have to hopefully spend a lot of extra money. You go, I already have governance in place for these other issues, for for safety or for financials and others. Why don't I just add this on? Ensure operational integration. We know how to, hit goals around here. Your credit union knows how to delight members. Don't make something new, just bake it in. And then last but not least, sustainability disclosure and assurance are changing rapidly. Plan ahead. Don't wait until your regulator tells you have to do something. If you are internally tracking things, you're going to want some history on data before you disclose it, and be in a position where you can have that kind of success. So with that, I think maybe Greg will come back, and I think we can take some questions.
Yeah, Christopher, it's really interesting to watch your presentation because it reminds me of presentations I've seen on how credit unions should handle cryptocurrency, only in the sense that there's going to be so much that's changing, but you need to have something in place for now and be nimble. And that seems like that's really your message, like have a plan, but realize that you're going to need to change it here or there at some point.
Certainly. Yeah, you have to be agile here. What the requirements are changing. And so being prepared, just like with cybersecurity or cryptocurrency, you're just going to be much better off. Mm-hmm.
So we have one question right now from Kathy. She asks, can Chris speak more to accounting for scope 3 emissions? There are frameworks like PCAF that have been adopted by financial institutions. Are there frameworks that are used by or underway for credit unions or more appropriate for the type of lending and services for credit unions, such as consumer loans?
Great question. I'm not aware of a framework specific or more specific to credit unions. I would say that it's still very much in its infancy. So no one is doing this well, probably. Even the most advanced companies who've been doing this for 20 years are still kind of beginning to understand. So if you think about, 100 years ago, pre-SEC accounting, that's kind of where we're at. When it comes to greenhouse gas emissions, I would say, again, to what we were just saying, what you want to do is start somewhere. So you're not going to get all of it. You're not going to get all of your financial, third scope. You're just not going to capture it all, I'm sure. But start where the heavy hitters are. And that's where you want to do that double materiality assessment. So if business travel isn't something you do a lot of, you can likely, estimate that. Just make a very rough estimate. Don't put in measurement and spend a lot of money. Focus just on those aspects that make up the majority of your scope 3.
You may only be able to speak to the US, Christopher, but did you have a good idea or estimate on the number or percentage of credit unions maybe that are either underway? I mean, I'm sure very few have a full plan on this, or am I mistaken on that?
I think you're right. From what I've seen at conferences and talked to peers, most credit unions don't have a full plan on this. I think that this is true in companies as well. The better governed you are, it's kind of a weird dichotomy. Usually the further ahead you are with this because you've thought ahead with it. So there's often a correlation between financial performance and getting ahead in this area, because your ERM group, if they're really on the ball, are likely already identifying ESG risks. And so if you come to them and talk to them about this, they may be a little bit further ahead than you think, but it wasn't they didn't discuss it this way. It was baked in. and that's good. And that's kind of what I'm advocating for. So I would say some credit unions are further ahead than they realize.
What if, we probably have, I'm sure, some credit union representatives on the line from countries where there isn't a lot of strong national regulation. Does it make it more important to pay attention to what's going on with IFRS and what they're doing? And I guess if there's no guidance from the national regulator, who do you look to then?
Yeah, certainly just about every country, but the US follows IFRS. So that's the
Right.
ISSB is certainly going to guide there. But think about your members. Again, I mentioned their passions are here, they lie here. And so if you go out and understand where they want to go, that's where the opportunity part of this is. If you're a credit union or a financial institution that's focusing on these issues, then you're going to serve those members better. And so it may not be that it's material to your operations. It may be that it's material to how you interact with your members. So I would focus on those areas in the absence of regulation.
All right. We don't have any more questions, Christopher. Is there anything that you'd want to add just as kind of a final thing to leave people with today?
Well, sure. So, I use some analogies that may have seemed a bit out there with space, sustainability, and other things. But I think this ESG and sustainability is an area where you can have that big thinking. So if you're a credit union that's growing or has passion, that has a membership with specific interests, this is an area where you can really, you can find your niche, I think. This is an area where you can be bespoke and be different and actually show how you're different from other financial institutions out there. So see this as an opportunity, at least as much or more so than a risk. And I think that's where you're going to find the most benefit.
All right. Well, Christopher, thank you so much. Very enlightening. I'm sure we'll have a lot of questions afterwards, and we'll try to get those on. And already getting some accolades in the chat there, so hopefully you can check those out as well. Well, if you like this event and you want to see others like it, or you want others to see it, you can refer them to the World Council YouTube channel. That's at youtube.com/WOCCU, WOCCU. It will be available there later today. And just a reminder, if you're interested in taking part in further education and networking sessions like this one, you can still register for the 2022 World Credit Union Conference. That's going to be held in person from July 17th to the 20th in Glasgow, Scotland. We'd love to see you there. And again, still have time to register at WCUC.org. Thanks for joining us, everybody. Have a great day.